Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day. As always, today we're going to be talking about another stock that was requested, and I'll actually go ahead and let you guys know this is actually one that I'm going to be accumulating here shortly. It's a company that I used to own, sold it, look really smart for selling it, but at the same time, I always wanted to get right back into this company. However, there have been some changes since I last owned it, and I guess we're going to be discussing that here today. So that company is Brookfield Asset Management, but now when I used to own it, it was BAM. There's a bit of a change, and we'll actually get discussing that here today. We're going to jump right in, actually, and let's talk about BAM. So this was the ticker that I used to own, BAM. And it's not the same company that I sold, okay? Back when I sold BAM, it was the full, we call it the mothership, actually. So within Brookfield, you have various entities that are all instruments that allow Brookfield to put their managed assets into, and as well as put their own equity into those same instruments. What I mean by that? Well, we have Brookfield Renewable Energy Partners, right? And so that is a fund that essentially invests and owns renewable energy assets. They also have the real estate branch, the infrastructure branch, etc. So on and on and on. You have these various entities that Brookfield will park money from its investors into, and as well as its own equity. So it owned a piece of it. And then we called BAM, if you were, let's say a Brookfield fan, you called BAM the mothership. All right. You bought BAM if you wanted exposure to all of it, as well as the fee generating sources. And what do I mean by fee generating sources? Well, in asset management, you make a lot of money, not only from the return that you generate on those assets if you have an equity stake, but you also generate fees. And we call that like the fee base, right? The amount of money that you can collect fees from. You want that number to be generally going up, and that hopefully is going up because you're doing a great job, as well as kind of marketing as well. So marketing and doing a good job should attract more capital, by extension increasing your fee base, by extension increasing your fees. And then you can generate more money that then can come to us, the shareholder. So Brookfield's done a fantastic job in all these categories, as well as being a strong compounder over the many years, and has returned a decent amount of capital to shareholders in the form of dividends and buybacks. Now, as of late, the change has been that they spun off BAM. And there was always a joke among Brookfield investors. There's, not many of us out there, but I guess since I've started this channel, I've gotten to know other people that are actually big fans of the company and as from an investment standpoint. But it's kind of like a running joke that it's one of the most complex enterprises out there in the entire world. And not the most, and it's nothing close to like the Chinese VIEs, but it's up there. And, it's here in our backyard in Canada, but American investors, we can still invest in, obviously. So the thing about Brookfield is they were already complicated. And then the management was like, what can we do today? All right. I feel like we could make it. No, we're going to make it more complicated. So that's what they did. They made it a bit more complicated, and that's fine. What that does probably offer us is a temporary discount. And that's kind of just my opinion there. It could be completely wrong, and you might disagree with me there, but a temporary discount relative to where maybe it should be trading at, because it's difficult to understand. That happens all the time. Like we said in the Sony video. Check out the Sony video if you haven't. Complexity is not attractive. Right? Market doesn't like complexity. Market likes simplicity. And you can see that discount show up in various conglomerates. General Electric had that discount some of the parts, right? Because there's just a sense of, I don't really know what's lurking around the other corner. It's difficult to come up with a price or a value. So there's also holding company discounts, right? You don't get the sum of the parts. So if you see anyone, and I'm going to say this nicely, because it's common to do. But let me correct myself before I continue. I'm not saying that you shouldn't do this level of analysis. I'm just telling you that you won't get that value. You just won't. The market, if it's offering you a premium to the sum of the parts, there's something going on, and I would be looking at the door, okay? Unless your number is incorrect. Your number could be incorrect, and it's actually far a bit lower. But it is very normal to have a discount. Now, the person that you're talking to might make the argument that the discount is too great. Now, that's a valid argument, okay? That we can start from there. But to say that there shouldn't be a discount to the sum of the parts, I disagree, and you should as well. Okay, over time, the sum of the parts valuation for these businesses is fun to do. It's necessary. It's good to do, but it's not going to be the way that you actually determine the true proper value. Okay, so what have they done here? Well, I actually took the liberty of actually stretching this out. So what you need to know is that Brookfield Asset Management, otherwise known as BAM, is also traded, and this is the old ticker, but now it's a new company. It was spun off from Brookfield Corporation, which was ticker symbol BAM, but is now ticker symbol BN. Okay, so here we are, BAM and Brookfield Corp. So BN, Brookfield Asset Management, Brookfield Corporation, okay? Now, the easiest way for me to explain it to you is that Brookfield Corporation has equity ownership in all the entities that we mentioned. BAM, on the other hand, will be following a completely different strategy. They are going to be distributing around 90% of distributable earnings to shareholders. So look at this guy as the cash cow. Look at BN as the one that's going to retain a little bit more of those earnings, or significantly more of those earnings, and figure out what else to do with it. Whether or not invest in other businesses, acquire other companies, other assets, etc. Build out their positions within their entities even more. Okay, because who knows? They could decide to do that. Now, BAM here is going to generate those management fees, and we calculate that, we get to the distributable earnings, very common metric for asset managers. If you look at Blackstone, they say the same thing, etc. All the guys, right? They have distributable earnings. And then of that, they're going to distribute 90% of that to the shareholder. So Blackstone, if you actually recall, has a very high dividend yield. So if we go to BX real quick, we're not going to be talking about BX in this video. However, if you guys want it, feel free on the Discord to actually put that into the requests, and I'll get to this eventually. But or if I find it a huge opportunity, I'll buy it and I'll just make a video on it. But Blackstone here actually has a fairly high dividend yield of 4.92%. If you dig a little deeper, you'll find that the distributable earnings percentage that they give out to shareholders is quite high. It's a cash cow. And arguably so, good, right? That's good because of the type of business that they're in. They're not really in the business of outright owning assets and building more assets out. They're in the business of managing assets. And so it makes sense to design the structure in such a way. If you are, let's say, a Berkshire Hathaway, which is a lot different, right? You're not in the business of managing other people's assets. You're in the business of managing your own, and you want to compound those assets. So that's completely different from what Blackstone is. Brookfield, you now have, I guess, a choice in how you want to manage that. BN is more accurately resembling in some fashion the Berkshire Hathaways of the world. BAM is you want to kind of play against, or not against, but an alternative to Blackstone. That's what Brookfield Asset Management is there for you to do. So you might decide to own both. If you've owned BAM before, the old BAM, you now own both if you didn't sell off the spinoff, but you have that. So BN is going to own 75% of Brookfield Asset Management, while BAM is going to have the 25% remaining ownership there. And then from there, it doesn't actually continue, but just take my word for it, or look at it for yourselves, that the structure then continues, and you see all the other entities of which Brookfield owns a percentage in each of those. So with all that, you do get the exposure at the end of the day to all these entities if you just go for BN. And that's the one I'm actually leaning into, because for me, I don't really care about the distribution. I don't care about them distributing a certain amount of cash flows to me, the investor. I would actually rather them just keep it and see if they can find another opportunity. I'll keep track of what they're doing with it and what returns they're generating, because that's the caveat there. If they're not really finding good opportunities, then you would make the argument they should be distributing more cash flow to shareholders. Now, if you actually take a look at the sum of the parts valuation on BAM or BN, you actually get, I think at the discount right now, is about 20 something percent. It's like 24, 23%, okay? Depending on how you look at it. And that is fairly steep. But again, we get back to the original point. The original point I made at the beginning of this video is that the discount should exist. There should be a discount. Not there needs to be, but there should be a discount. So if you think that delta is your benefit, your appreciation, think again. Somewhere, perhaps, but not the full amount, okay? And there is, of course, the projections from Brookfield. So I will state the projections from Brookfield is about an 18% CAGR on assets that they're going to manage. So what that means is that they're going to raise capital, and there's a strong appetite for alternative asset investing. Now, let's think on that for a moment. What do you think, and this is a legitimate question, so I like to be interactive with my audience. What do you guys think is the main competitor to Brookfield for managing assets? All right, take a quick pause there. You're probably thinking to yourself, and legitimately start answering. There's no wrong answer. No one's going to judge you. There's not someone standing there. I don't even know if you got the wrong answer or right answer. I mean, who knows? But I think I gave you enough time there. And if you answered anything, if you answered like, Blackstone or BlackRock even, that's a good guess. That's a good guess. But no, management actually says their strongest competition is fixed income. Okay. Oh, well, that's interesting. Why is that? Well, fixed income in the olden days, it was very probable that you could build out a very strong portfolio made up of fixed income instruments, bonds, etc., stuff like that, and annuities and all that jazz. So what happened in the past 20 years? Well, yields have collapsed. And actually, don't take my word for it. We'll go straight to the Fed database, right? So we have the federal funds rate, and this is correlated strongly with yields. Now, if you don't live under a rock, you went outside before and you noticed, oh, my bank account now offers higher interest rate. Well, depending on your bank. But you'll notice a lot of offers for high yields. You'll find places that offer you 4%. You'll probably notice that you try to go buy a car now and you might get, I don't know what percentage they're offering now, but something way higher than it was a couple years ago. You go try to buy a house, same thing. And so you notice, oh, there's a lot of yield out there. Like things are expensive now. And that's true. That's what's happening. So if you take a look down there at the bottom right, well, what do you notice about yields? They spiked up. Now they're much higher than they were before in 2019. Again, this is the federal funds rate, but getting the idea of like just the gist of yields. So that doesn't bode too well for something like BN, right? And that does make sense. So I do think the recent price action in asset managers, especially alternative asset managers, it makes sense to me, okay? I get it. I get what the market is saying there. I get that the projections of 18% CAGR were based off of previous projections of interest rates, et cetera, blah, 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 blah. Now, here comes the next part. So if you guys recall, and I know I've been on like a hiatus on videos and stuff, but now that I'm back, okay, all those subscribers that have watched my videos for a long time, you guys know how I feel about interest rates. You guys know the nuances of how I feel where we're going in terms of interest rates. And that is in one direction. So I think the setup is actually quite nice here for BAM. And that's just my opinion. Oh, sorry, BN to be specific, but both at the same time. I think the setup is quite nice here. And I could be wrong, and interest rates could continue to rise. And so you have to consider that in your exposure, because if that is the case, well, there is a branch, and I know a subscriber that will be very sad if I don't mention this company. And shout out to you, you know who you are. Oaktree. Okay, so they did purchase a huge stake in Oaktree. And basically, if you want Oaktree exposure, you get it through Brookfield Corp. Now, with that being said, the interest rate exposure there is quite nice, right? They will have more ample opportunity from that exposure. So there isn't like every business line is going to be destroyed and whatever, but it does kind of bring a chink to the armor of, okay, well, if now there's a viable alternative to alternative assets, funny we say it that way, then it brings into question, okay, well, how much are they going to be able to grow, right? Their fee base. That's the key. So I think longer term interest rates are going to come down, and this moment is going to be looked at as an interesting period or an interesting opportunity to get involved in some of these asset managers. And I got to be honest, you look at some of the other ones, BX as well, not excluding them. They're down. They're down. They're not super down, but they're down. They pulled back. And you also have KKR, another solid one. Also a bit of a pullback here. And so they're not at ultra low levels. And honestly, KKR is a far simpler business structure. So is Blackstone, way easier to understand. And I actually got a caveat that we take a look at Blackstone, or sorry. Blackstone actually. And we do see a massive, like you're basically buying a REIT. Okay. So if you didn't know that, just keep that in mind. When you buy Blackstone, you're buying real estate. And then when you're buying KKR, you're buying a more diversified portfolio, a very diversified portfolio. So I'd almost say that if you're looking for diversification, KKR and Brookfield up at the top, and then you have Blackstone, which is much more concentrated into one asset class. But and then you have other asset managers, and there's always new asset managers coming on the market. I mean, there's Carlyle Group. There's a couple other ones. More recently, there was an IPO with Blue Owl Capital. I might do a video on them one day, but yeah, these are kind of like an introduction to all the asset managers, with mainly focusing on BN here. So with that being said, I am going to be accumulating BN. You should probably see it in the nearest portfolio updates, which I haven't done one in a while, but now that I'm back getting in the swing of things, that should be coming out soon. So what do I like about Brookfield Corp? I like that there's potentially, my opinion, a strong discount right now, deservedly so, out of confusion. Okay, the discount to some of the parts is quite low, should not close, but it should somewhat catch up a little bit there. And I also like the setup where there might be some pessimism on projections as far as the fee base that they're able to generate, as far as the assets they're able to accumulate. They do have a lot of dry powder, which I wanted to show you guys here in these two charts here. So the first one is the fee-bearing capital, FBC. So we see the breakdown here, and if you didn't know, this is exactly what they're in. So credit insurance solutions, that's the business line that should do well if interest rates rise. That should do well, okay? And the other parts or the other components, we see infrastructure. This is that alternative asset investment. You can invest in that directly. You don't need to invest in BN, by the way. You can go and invest directly into that entity and then get that exposure there. You also have the real estate component. Brookfield owns a fantastic slew of properties across the United States, specifically that I'm talking about. And if you've been to New York City, you've seen the Brookfield Center, all that jazz. They own a lot of A-class properties and office, retail, etc. And they've been a huge advocate, actually, for really kind of calming people down and really thinking about, okay, well, in this crisis of office and this crisis of commercial real estate, you really want to focus on that high quality properties, not the low quality ones. And then we get down to the renewable parts, which is the $47 billion. So this is what I was talking about. They're a huge investor in that space as well. And then they have the private equity arm at $39 billion. So all in all, $418 billion, massive, massive portfolio. Now you say they're all fully invested. No, they're not. They're not. I don't think they don't have nearly as much dry powder as something like Blackstone does, but they have a decent amount of dry powder, and they have about $87 billion in total that's allocated towards those same categories we just discussed above. And that's oftentimes the difficulty, the balance approach between everything, because we need to find places to park capital. So you have all this capital, that's great, oh, great, tons of capital. But where do I put that capital? And not all the time will there be tons of opportunities, right? And so it's actually fairly good. They still have that dry powder as opportunities start to show up, as, let's say, more distress kind of pops into the real estate sector. They're going to have plenty of opportunities in there. And you can see that they have about $22 billion in reserves there. They have $22 billion in infrastructure reserves there. So all that fee-based stuff should come online fairly shortly. And again, their projection was still about 18% up until 2027. So will they get there? We'll see. We'll keep an eye out for it. But for me, what I'm doing with my portfolio is I'm going to be allocating. If you guys want to find out what the old allocation was, go check out the old portfolio updates. You can see exactly what it was. For sure, it's there in the first half or first quarter of 2022. And then you can see over time, if you keep following the in chronological order, the portfolio updates, you'll see eventually, when I sold and why I sold. But here I'm looking to get back in, excited to get back in, and rejoining myself with an old friend, you could say. That's kind of sad to say in the stock market. But anyways, with that being said, guys, thank you guys so much for watching. If you guys enjoyed this video, feel free to like, share, and subscribe. And if you want to join the community, feel free to join the community. And I'll see you guys on the next one. Bye.